Pike, sure.
I played high school golf with Coleman.
Did you?
7.
Yeah. He was very nice to me. Good Mormon with a lot of kids. He became the club manager. He was assistant pro with Rick Atkins. Yeah, I actually had a house. I lived there. I built a house there in '83 and was there until 2002.
I volunteered at that senior open, and I was in training for the younger guys open down in Tacoma at Chambers Bay, and I also worked with that.
Yeah. I worked at PGA. I was greenside reporter at a computer that put in, but they hit the.
Still got my red shirt on the hanger.
I tell you,
It's nice to be an I'm I can be here.
Yeah, you're gone. You have to do your part.
Fun to be here.
yeah. So you still play a lot?
Oh yeah.
Where do you play?
I live on a course in Tacoma called Highlands.
Oh yeah. I live in Allen on Lakewood Village.
Very nice.
So you built a house there. When we moved out of the house, we've been 20
Great course.
years there.
We like town, we like to take them there. When you get out, come in, it'll be a special. Sometimes you see them table people, the waiters go out to the room. It's like, really? Yeah.
Good surprise.
I we still have answers. I like that. I love they have
We had a garden.
20% tip.
I complained and didn't cut it off. We got a
We
grandson.
haven't been able to remodel it. Yeah.
This is a really good cover business.
They raised their prices. And on that.
Next time we'll produce a bad and then we used to love and they got that
Sat there for a while. Where over there said, we were in his area. So he was very about that. He gave double.
Yeah. So we, but yeah.
That's what happened.
We've always had good service, but I think he, like he said, he didn't know we were.
Yours is already on. Testing? We good? Okay. I know some people are still getting food, so just keep going. But we are going to get started. First, I'd just like to say thank you for joining us. If you didn't meet me out there and you don't know who I am, I'm Allie. I'm on the administrative team here at Parker Financial. You've also probably talked to me on the phone multiple times. Before we get started, I just have a couple of quick housekeeping items. If you need the bathroom, it is going to be out this side, straight down the hallway on the right. And then secondly, if you have your phone on you, we ask that you turn it off for the duration of this presentation or silence it. That way we can avoid any interruptions. And now I am very excited to introduce our incredible lineup of speakers that we have this evening. To begin, please join me in welcoming Natalie Marva Romeo. I think I said that right. She is the Senior Portfolio Specialist with Vanguard. She consults with financial advisors on investment strategies and brings more than 25 years of experience to the table, including leadership roles at Morgan Stanley in Philadelphia, New York, and London. Thank you again, Natalie, for joining us today. Next, we are honored to be joined by Weston Wellington. Weston began his investment career before the era of personal computers and digital finance. For over 30 years, he has been the key voice at Dimensional, where he helps financial advisors and their clients better understand the principles of sound investing and how to navigate changing market cycles. He also gave me the fun facts that he likes to ride Harleys, and he has a wedding venue at a dairy farm in Pike, New Hampshire. So thank you, Weston, for joining us. And finally, we have Jason Parker. Jason is the president and founder of Parker Financial, the author of 2 books on retirement planning, and the host of the popular podcast Sound Retirement Radio. When he is not helping clients achieve clarity, confidence, and freedom, he enjoys competitive pickleball games and listening to podcasts. So there's Jason.
Thanks, Allie. Doesn't she do an awesome job? I have to say I am so grateful for all of you that are here tonight. I should also recognize we've got people joining us from all around the country this evening. So we've got some people live streaming with YouTube, and then we also have people that signed up digitally on the webinar with this device right here. So if you're interested in a replay after tonight, we'll have that available for you. But it's just such an honor for me to get to walk life with so many amazing people and get to do really significant, meaningful work that really changes people's lives. And you know, there are 3 things that we're always looking to deliver when we help people, and it's clarity, to know what's most important in your life, confidence, to know that the numbers are going to work, and ultimately, when you have clarity and confidence, our hope is that you're going to experience freedom. Freedom from worry, freedom from fear, freedom from greed, freedom to go out and spend your time with the people that are most important to you, doing the things that are most important to you. And we talk a lot about planning. Of course, you can't have an investment strategy before you have a plan. The plan has to come first. But tonight I wanted to have an event to talk about the implementation piece. And many of you have already experienced what this looks like to be clients of ours and see how the investment process works. But there's a lot of people out there that don't know what that looks like. And so I invited 2 guests to join me tonight to talk more about the investment side of the equation. Several years ago, when my son was maybe 10 years old, I was asked to coach his basketball team. And I didn't know anything. I didn't play basketball as a kid. I didn't know anything about it. And so I picked up the book Wooden by John Wooden, who's considered to be one of the greatest basketball coaches of all time. And Coach John Wooden spent a lot of time teaching the fundamentals. In fact, the story goes that the first practice of every year, he would teach his players how to put on their socks and tie their shoes. It was all about the fundamentals. And you're going to hear tonight a lot of that same type of philosophy. Fundamentals, what makes up a good long-term investment strategy. But the other thing that Coach Wooden taught, he said, you become the average of the 5 people you spend the most time with. And who we spend our time with is incredibly important. And we're very selective. You know that we custody with Fidelity Investments. We have Vanguard here because we use a lot of the Vanguard ETFs in the portfolios we build. We have dimensional funds here. We use a lot of the dimensional funds in the portfolios we build. And at the end of the day, life is all about relationships. It's about who are you spending your time with. And tonight, we want to talk about how these relationships are really designed to enhance your life as you're preparing for and transitioning through retirement. And my hope is that after some time together, you're just going to walk away from this tonight with an even greater sense of confidence in not just the planning that we do, but the investment management. In the folders that you have, there's some scratch paper in here for you to take notes. And I've got a couple of handouts. These were provided, one from Dimensional Funds and the other one from Vanguard. So some additional material for you here. As we're going, we want this to be interactive, but we have some defined questions that we hear from people a lot. So we're going to start tonight's conversation as a panel discussion, talking about some of the questions that we hear often from people. But then we want to open it up to you, and we want to hear what's important to you. What are the concerns that you have? And there's a lot of them right now. You know, there's concerns about tariffs, there's concerns about new tax law, there's concerns about valuations and maybe U.S. valuations being stretched. There's concerns about artificial intelligence and the impact that that's going to have on jobs and the economy. And so we just want to give you a couple things to think about as you're navigating what some people might find fearful. I don't find it that way at all. I see just a ton of opportunity, and I really think things are good and getting better. It's really the way that I see it. So as we're going, if you'll write down questions tonight, I want to make sure that we're answering your questions. If you're joining us on YouTube or on the webinar, we also have an opportunity for you to ask questions. We're going to try to get to as many questions as we can. And then one last piece I want to make available to you. Some of you have this ebook already, but I have an ebook in addition to the two printed books we have. And this one is specifically investing in retirement. And it covers a lot of the topics we're going to cover tonight. In your folder, you can request that, and we can email you a PDF document. So with that, let's go ahead and get started on some of these questions that we hear from people frequently. And the way that I thought we could do this, you guys, I don't think everybody needs to answer each question, but if you feel really compelled to add your voice to one of these questions, feel free. But now I thought I'd give you the first one since you're sitting closest to me. The first question, I'll hand you the microphone here. I want to talk about, I'd like you to talk about your global market outlook. What are the opportunities to capture? What are the risks that we need to be aware of? Where are interest rates headed? And given current market valuations, such as the CAPE ratio being at one of the all-time highs it's been in the last 40 years, should we expect the market to continue to go higher, or is it time to prepare for a market pullback? And nothing, a lot of questions there. Take it away.
All right, great. Well, thank you, Jason. I'm really happy to be here tonight, and I look forward to hearing the Q&A at the end too. But let's start with some of these questions that Jason asked. First, I'm like you. I think there is opportunity in the market. I think there always is. And I'm feeling pretty positive about things as well. One of the things I'm feeling positive about is something that I think we got this year that you don't often get in life. And that is a second chance. And what do I mean by that? Well, think back to April when the market took a huge dive, right? And we were kissing a bear market. There's probably some people in this room that said, I want to buy. Probably other people in this room say, I want to sell. But where are we now? We're already back up past zero, right? The S&P 500, I think, is up 8% year to date. And so what I mean by a second chance is if you were in that club that said, I'm going for the hat trick, large cap tech is going to have its third year in a row of plus 20% returns, and that's where I'm going to put all my money. What I mean by a second chance is you have an opportunity to step back and say, okay, the market's back to where it started, even beyond that. And there's an opportunity to rebalance and diversify. Because as much as there is opportunity, we're also in a tough part of the alphabet. TUV, tariffs, uncertainty, and volatility. So what Vanguard would say, what I would say is, it's a good opportunity to rebalance and diversify. If you're talking about equities, maybe you want to put some value in there to counterbalance the growth of large cap tech. Maybe you want to have some international to balance out the US. Maybe because it's an uncertain environment, maybe you want quality. Some compounding companies that can grow their dividends year after year. And as it relates to international in particular, I have a lot of conversations with people about international. They're like, why do I need it? It hasn't outperformed in a long time. And I think the reason is because it is uncertain and we don't know where the returns are going to come from. And if you do look at international returns today, it's not all about a weak US dollar. If you were to strip out the impact of a weak US dollar, international is still outperforming the US. So it's just a way to diversify. And the other thing I was thinking about is fixed income, right? We had a once in 100-year event in 2022 when fixed income and equities went down at the same time, and that was pretty tough to take. But where we are today, you know, fixed income is yielding pretty well. Bonds are back. And you can invest in fixed income and get a really nice return with a lot less volatility than equities, right? So if your advisor is saying maybe you should be thinking a little bit about fixed income, I'd say that might be a great way to offset some of the equity risk in your portfolio. And then the last thing I would say is, you know, take a look at your cash. I think there are some people that I've talked to that are maybe keeping too much money in cash right now. And what I mean by that is if you really don't need it right now, but you have it in cash and you're like, but it's paying high yield, well, the minute the Fed takes rates down like that, the yield on your cash is going to go down too. But if you put some of that cash into fixed income with a duration that's matching your investment horizon, you'll have a little bit more durable yield. So just some food for thought on where I'm seeing opportunities in the market.
Thank you. And I'm so glad that you mentioned opportunities to capture specifically with developed markets and emerging markets and the way that we saw that play out. Do you want to take a minute and just talk about how being globally diversified helped to offset some of the volatility that we saw in the US markets in April of this year?
Yeah, I mean, if you just even look at the returns year to date for, I'm just looking here on my screen, I wrote down through yesterday. If you look at developed markets, almost up 20% year to date. Emerging markets up 18, US up 8%. And when the markets went down in the US, they didn't go down as far internationally. And you know what, maybe we'll do this on kind of play a little game about international, see if anybody gets this right. I got it wrong, so I'll tell you that right out of the gate. But if we looked at all the countries around the world, developed market countries, what do you think was the best performing country in 2024? It's a good guess. Not right, but it's a good guess. I guess the US and I was wrong. Israel. Israel was the best performing developed market country in 2024, and they had a war going on, which I think hits to the other thing you were asking about, the risks in the market. There's geopolitical risk, right? A lot of it throughout the world. There's tariff risk, there's inflation risk. Well, the first two of those, you know, we as individuals really can't do anything about the geopolitical risk. Can't really do much about the tariff risk either. And our research would show the geopolitical risk initially, you know, there's usually a shock to the market, right? Knee-jerk reaction, investors are afraid and the market goes down. But back to your point, sir, about the Ukraine, back in 2022, you know, people are like, why would you invest in Europe? There's a war in the Ukraine, it's gonna be in Europe any day, their energy prices are gonna go skyrocketing, and what happened? Europe was one of the best performing markets for the 12-month period after that war started. So you can't control it, and sometimes it doesn't turn out the way we would think it would. And then as it relates to inflation risk, that's one I think we could do a little bit about, right? That you might do in portfolios. If you're in the accumulation phase of life, then you'd probably just be in equities, right? That's the best hedge for inflation risk. If you're in the retirement phase of life, maybe you and Jason and team are talking about adding treasury tips, right? Treasury inflation protected securities or commodities to your portfolio to kind of hedge for inflation risk.
Thanks, Natalie. And Weston, I want to bring you into this conversation. I can see the wheels turning over there. You've got some good information to share with us. One of the things Dimensional teaches is they say you want to be globally diversified across asset classes, across the entire globe so that you can capture opportunities wherever they arise. And this has been a great year that's really demonstrated that. Most of you have experienced that as clients. But Weston, do you want to speak to this, any of these points in terms of opportunities or risks?
I'm going to make most of my comments in kind of a big picture manner. We don't think we can add any value for investors at Dimensional by making predictions about stock prices or interest rates. We've been in business for over 4 decades, and we've grown from 0 to well over 800 billion without making a single forecast about any stock market around the world or any forecast about what's going to happen to interest rates. And I would urge all of you to go about thinking when you're constructing and monitoring your investment portfolio, hopefully with the advice of an advisor, to avoid the temptation to listen to people who claim to be able to predict the future. I'm a history major, not a finance guy. Don't ask me to run regressions or compute t-statistics. What I have done is carve out a role at Dimensional as sort of the reminder after a year or two goes by. Here are all the unsettling headlines and predictions you read a year ago, and here's how they turned out. Now, if you pay me to make a forecast, I'll make a forecast. And I would urge you, whenever you read a forecast that you find either alarming or maybe encouraging, write it down. Just a sentence or two. The date, the level of the market or the stock or whatever you're supposed to buy or sell, and what the idea was. Why should it happen? And if you keep a little journal like that, I'm pretty confident you'll be surprised by how often these predictions are wrong. They're not always wrong, sometimes they're right. We tend to only hear about the people who got the forecast right. We don't hear about the people who got the forecast wrong. So to summarize my viewpoint, I think all of you are hopefully following a diversified, broadly diversified investment strategy. And depending on your age and your income and your financial needs, you either have a small amount of stocks or maybe a large amount of stocks. And you tune out the noise of those trying to predict, is this a good time to be holding stocks or not? Is this a good time to figure out what the Fed's going to do or not? Keep in mind, every time you read about a prediction, you're competing with literally millions of other investors who are concerned about all the things you claim to be concerned about. Tariffs, the debt situation, the political situation, on and on. And if you can honestly say to me, I know something important about the economy or the markets that nobody else knows, fine, maybe you have a trading opportunity to capitalize on something. But I think in this competitive economy and marketplace, it's a very, very overconfident position to take that you know more than the collective wisdom of millions of other investors. So I don't know where the market's headed next. My best guess is that stocks are priced every day to deliver a positive expected return. But there's so much variation around that expectation. You don't want to get too excited about any activity, up or down, for next week, next month, next year, even the next 5 years. And just a little story about the virtues or perhaps the dangers of international diversification. A lot of talk about now maybe we should be adding more to our international diversification or less. It depends on your viewpoint. Suppose we were having this conversation this evening in Tokyo, not here in Washington State. And suppose I, as a representative of Dimensional, were trying to make the case, presumably along with my colleague at Vanguard, that it probably made sense to have some degree of international diversification. All you Japanese investors should own something other than just Japanese stocks in your portfolio. What might your next question be? Well, how have they done? Well, actually, Japan has been the best performing stock market in the entire world for the last 20 years. So international diversification wouldn't have worked very well. What would your reaction likely have been at that time? Huh, just what we would expect. We have the best economy in the world. We make Toyotas and cameras and copiers that are much better than anything you folks make in the United States, and we are just getting started. It was a Fortune magazine article, September 1989, how Japan was going to blow us away in industry after industry after industry, construction, services, retailing, banking. They quoted one professor saying it's a techno-scientific culture never seen before on the face of the earth. Suppose I were trying to persuade you as a Japanese audience of investors, I hear you. I don't have any data or any obvious reasons why Japan won't continue to be a roaring economic success. All I have is an intuition that there could be some state of the world in the future where maybe Japan isn't the best performing market. What's happened since that time? Has Japan suffered some horrendous earthquake or tsunami wave inundating the cities or a colossal depression? Nothing of the sort. Still a very prosperous country. How's the Japanese stock market done? Among the worst performers over the last 20 years. Is this a prediction that somehow the U.S. might be a terrible place to invest in the next 20 years? Not at all. But it is a suggestion we should be very cautious in our assessment that we can interpret the current headlines and the current economic data and come up with a bulletproof forecast about what this market will do or that market will do. So I would urge all of you in your investment activities to keep a broad diversification. I don't know what the right allocation would be for U.S. or non-U.S. stocks for your situation. That's a great conversation to have with an advisor who knows your situation personally. But I would end by saying, here we are at a golf club, and for those of you so inclined, spend a lot more time practicing your golf game than reading the financial pages. And you'll likely have, in my belief, a much better long-run investment result. Thank you all for coming.
Thanks, Weston. Okay, the next question has to do with global diversification. There's several questions here, and I'll just rattle them off and then hand it over to you, Natalie. Actually, Weston, I think I'll give you first shot at this one. How should we think about global diversification? How should global market capitalization influence how we allocate and diversify investments? Will the U.S. remain the dominant market globally, or should investors expect more equal global leadership? With China being the world's second largest economy, but only about a 3% weighting in the global market cap, and given their strained relationship with the U.S. and their behavior towards Taiwan, should we consider removing China from our asset allocation? And how does currency hedging impact fixed income? So, wherever you want to start, Weston.
There are a lot of questions there, so I'll hope to address all of them. I think every investor should approach the international diversification issue by adopting the same mindset we would take in investing in the entire U.S. stock market. If you're investing in the U.S. stock market, the sensible starting place is what we would call a market portfolio, meaning literally every single stock in the entire U.S. marketplace in terms of its natural market weight. And there are market-weighted funds, I'm sure Vanguard has one, that can do this sort of thing. It doesn't mean it's the best solution for you, but it's a great starting place. You sort of set the pin in the ground and say, well, maybe I'm willing to take perhaps a little more risk and overweight my portfolio compared to that natural market weight, and have a bigger allocation, let's say small company stocks, which historically had higher returns. I would take a similar attitude when we're talking about assembling an international portfolio. Let's start with how the rest of the world has chosen to hold its wealth. Meaning we take all the stock markets in the world and construct a global market portfolio. every country with a stock market, with every stock at its natural market weight. That's the starting place. It doesn't mean it's the best portfolio for you. Today, I'm not sure what the exact percentage would be. Maybe it would be 68% in the US and the balance in other markets. That's a sensible place to start. So I think everybody should sort of start with a market portfolio and then take your temperature about how you feel about your portfolio when international stocks don't do as well as US stocks or vice versa, and ask yourself, could you stick with this portfolio if things change unexpectedly? And then recalibrate that portfolio to one that you can live with. The most important thing about an investment philosophy is that you have one. And I believe most investors are best served by an investment philosophy that says, I don't have any special information about which stocks or which markets around the world will do better. I'm going to take the collective wisdom of millions of other investors who have wrestled with this question. I'm going to take their solution as the best solution. Now, there were some other questions here. Will the U.S. remain the dominant market globally? I'm not even sure what dominant market means. It's a very large market. To the best of my knowledge, you correct me if I'm wrong, I think Denmark has been the best performing market over the last 10 or 20 years. So by some measures, maybe we should have all of our money in Denmark. But I don't think that would be a great idea. But again, start with a market portfolio, and to the extent you want to deviate for reasons you believe in, if you're going to deviate from any market portfolio for any reason, I would urge you to write it down, the reason why you think it's going to be a better solution. You might be surprised how many times, if you revisit these predictions you make a year, 2, 3 years later, you go, what was I thinking? Why was I so enthusiastic or negative about this or that? What about China? China's part of a market portfolio. Probably should start with thinking you should have some Chinese exposure. But if you're going to lose confidence in your entire portfolio if you read a scary headline about China, okay, that's your personal preference. Throttle it back to where you can sleep at night, no matter what the headlines are, positive or negative, coming out of China or any other country. How does currency hedging impact fixed income? Well, if you have non-US bonds, fixed income instruments, your rate of return is going to be a function of two things. The rate of return on those bonds and the fluctuations in currency when you take those British pounds or euros and convert them back into dollars. It might enhance your return. It might penalize your return. There's no right answer here. I think the starting place, from my view, would be you would want to hedge all of your foreign currency exposure. Because in my belief, most investors are using fixed income as a risk reducer for the riskier part of their portfolio, stocks. So if fixed income is, the primary purpose is to be the risk reducer, adding a foreign currency element is going to amplify the swings in our fixed income from year to year. Perhaps not what you're trying to accomplish if their primary purpose is as a risk reducer. Did I leave anything out?
That's pretty good.
Okay.
That was really good.
I had the opportunity to travel to Italy recently. I just got back. And one night when we were there were 12 of us on this trip, and we were trying to figure out where to go to dinner. And the gentleman that worked at the front desk of the hotel made a recommendation. And then we looked up on Google, and we found a restaurant that had over 3,000 reviews. 4.8 was the average, very highly rated out of 5 stars. So we had a decision we had to make. Do we trust the concierge, or do we go with the 3,000 reviews? And this gets back to Weston's point, where you have all of these market participants. Alan Greenspan once said that when it comes to the stock market, you have people buying and selling every day, and they both think they're right. But in between all the buying and the selling, what they're determining is price. And the other thing that they're determining is where dollars should be allocated across the globe. So this is what we do. We, like Weston was saying, we take a globally, we take a global approach to diversifying our portfolios using the market capitalization as a starting point for how we allocate those dollars. And we're doing that because if you think about this idea of the restaurant, you've got almost 3,000 people voting on what the best restaurant is. You have millions of market participants voting on how dollars should be allocated across the world. And to the point that Weston had, we don't try to pretend we have more or better information than anybody else as our starting point. A couple other things, I should have said this at the beginning. Don't take anything we talk about today and go change anything in your investment strategy without talking to an advisor first. I had this happen recently where we were talking about the benefits of international and how well it's done, and I talked to this lady and she had sold everything and moved it all to international. We don't want you to do something like that. That's not the purpose of our meeting tonight. The other thing I want to say that really sets the work that we do apart from many other firms is that our specialty is retirement. It's walking life with people as they're getting ready to retire and transitioning into and through retirement. And it's it's nuanced because time is the one asset that you don't have more of as you're making the transition through retirement. So we have to think differently about how we allocate dollars. And it's one of the things I think that really makes the work that we do unique, because we're solving for the short-term needs, income needs, but we're also planning for the long term to make sure that we're outpacing inflation and giving your money the best chance to work hard for you over time. But Natalie, anything you want to add to what Weston said there?
I agree with you completely. We do the same thing, market cap weight. That's what our starting point for our models, and of course people can customize from there. And I also agree with you on hedging and fixed income. That's supposed to be the ballast of your portfolio. And if you're letting currency volatility in, you're not maybe going to get that capital preservation and offset to equity risk that you would expect. With China, the one thing about that I think about, and I should say that Vanguard has filed for emerging markets ex-China ETF because there's a lot of demand from advisors and clients. But it is part of a fully diversified portfolio, and as Jason said, it's only 3% of the portfolio, but you also have to think underneath, think about all the US companies that have exposure to China. Just by taking Chinese companies out of your portfolio, you're not really eliminating exposure to China. NVIDIA alone gets 13% of their revenues from China. And I would say that political things aside, China is the second largest economy in the world. They have 6 of the 10 EV battery companies in the world. BYD, their electric vehicle that is not sold in the US, but is sold everywhere else around the world, is taking first place. So there's a lot of good companies there that might be beneficial to your portfolio, but knowing that it might be not in line with your values, there are options for taking at least the Chinese companies out of the portfolio.
Thank you. Write that question down, Jim. We're going to come back and do Q&A in just a minute here. How are we doing on time? The next question has to do, okay, so now that we've created this globally diversified portfolio, we've thought about your plan specifically, and we've allocated some money towards short-term for income needs. And then we also have money that's moderate term, and we have money that's long-term, money that's not needed for a long period of time where we can afford to be more aggressive with those dollars. Time is the cure to the volatility of the stock market. The more time we have, the more risk we afford to take. The next thing I want to talk about is once we create that portfolio in those time segments, it's portfolio tilts. And Weston, I think I'll start with you because Dimensional has done a lot of work about factors and have Nobel Prize winning economists on the board, deeply respected in the investment community. So would you take a minute and talk about, once we have this globally diversified portfolio, what are some of the ways that we might want to tilt a portfolio?
A little bit of history here. So financial economics as a subset of the study of economics kind of barely existed back in the 1950s and early 60s. And then professors like Gene Fama and Merton Miller, both future Nobel laureates, began to study these issues in detail, and we finally had data that could be digested and analyzed by the new computers that were appearing. They began to do studies about how securities behave. There are thousands upon thousands of stocks. Do they all have the same expected return? Or are there differences among broad types of stocks? And if there are differences, well, where are they? What types of stocks might have higher or lower expected returns? And as study after study after study took place, gradually a number of various factors emerged. Not controversial, hopefully among most of us, that stocks in general have higher expected returns than safe fixed income. But within the broad universe of stocks, in the US and then further in international companies, when more research was done there was powerful evidence that stocks of small companies, think Red Robin Burger rather than McDonald's. McDonald's is 2,000 times the size of Red Robin. Both in the same business, one's really big, one's pretty tiny. When you form portfolios of really small companies and compare them to really big companies, on average, the stocks of the small companies have done better. Not reliably, not every year, not even every 5 or 10 years. But your best guess is that this so-called small firm effect exists both in the US and in markets around the world. Dimensional got its start by launching the very first small company asset class fund. I don't use the word index fund because there was no index to follow when we started it back in 1982. We just bought a universe of 2,000 small company stocks and kept it small company stocks. And here we are 40 plus years later, same strategy. Further research by various professors uncovered what we call a value effect. Value is perhaps a little bit of a misnomer. It's almost more of a low price effect. Stocks selling at lower than average prices relative to almost any fundamental variables. Low prices relative to profits. Low prices relative to dividends if they have any. Low prices relative to their asset values. Those stocks had on average higher returns than growth stocks. None of these premiums that these academic professors have discovered are bulletproof. Doesn't mean you get them every year. It means your best guess is that over any period, 1 week or 20 years, you will see a premium. And so the question for investors is, if I start with a market portfolio, everything in its natural weight, should I tilt my portfolio, have an even bigger helping in shares of small companies or these low-priced value companies? And the answer is maybe. Depends on your appetite for risk, your appetite for looking different from the broad market. If growth stocks are shooting the lights out like they have in the last 2 years, value stocks may have had positive returns, but they could be lagging behind growth stocks. And you may be tempted to jump horses in the middle of the stream, so to speak, just in time perhaps to watch growth stocks do poorly and value stocks shoot the lights out. This is a great conversation to have with a financial advisor. How much, if any, should I be tilting my portfolio away from their natural market weight? So we at Conventional have made a business out of trying to identify these factors, but trying to be very careful that they are properly explained to investors. So everyone who has got an equity portfolio understands why it looks the way it looks and why it might behave differently from a simple broad market portfolio.
Take your second question. Yeah, so the second question is, should investors overweight growth companies and tech given their outperformance the past 20 years? Well, that's kind of looking back, right? Investing by looking back, I'd rather look towards the future. And so when I think about that, and I think about the technological revolution that we're in right now with artificial intelligence, I think about it in 3 different stages. So think of stage 1 as being the companies that build the components of the technology, right? The NVIDIA's, the Taiwan semiconductors, right? Those are the ones that are doing really well. NVIDIA's over 4 trillion in market cap right now. And then phase 2 being what they call the hyperscalers. So Meta, Amazon, Google, they're the companies that are buying those components from NVIDIA, TSMC, and they're building the data centers and the large language models. Spending a lot of money. Are you seeing the benefit yet? Probably not. And if it stopped right there, maybe it would not be the revolution that we think it probably will be. At least our economist Joe Davis does think that over time, artificial intelligence is going to be transformational. Maybe as transformational as electricity. Now, I wasn't around when electricity was founded, probably none of us were, but if I think about it, I'm like, wow, you could turn a light on, you could stay up later, right? Before they couldn't, the day was done probably when, the sun went down. But that leads me to phase 3. We really need to see phase 3 when companies throughout the market, healthcare companies, industrials, consumer staples, they buy that AI, hopefully put it alongside their smart people and their companies, make their businesses more profitable and more efficient. And then we really see the transformational benefits. So thinking about those companies I named, or sectors, industrials, consumer staples, healthcare, those aren't technology companies, right? And I think back to the last time we had a technological revolution, the internet. So many things have happened that we never would have expected, right? We couldn't forecast where the efficiencies were going to come from. I think about when I was in college and I would want a pizza, Domino's pizza. How did I get it? I called on the phone. I have 4 kids. They would never pick up a phone and call for a pizza. They look at an app, right? And what enables that app? Well, it's the internet, right? And if you look at Google, Alphabet, and Domino's Pizza, they happen to IPO on the same day. And there have been times when Domino's has done better than the technology company, Alphabet, right? So think about if anybody went and got a physical this year. I got one a couple weeks ago, and my doctor's like, do you mind if AI takes notes? Wow. I guess, go ahead. I'm sure she was happy because it's going to save her time. But think about this. Think about if you're waiting for a drug to be developed for someone in your family, and they can use AI to help that pharmaceutical move through the clinical stage process, which takes years sometimes. It's a very data-intensive process, but you put AI on that, and all of a sudden, maybe a loved one has a solution they need. And if you think about it from an investing perspective, you're taking all that money that's put into research and development, and you're realizing, profits for the company sooner. So, long-winded way of saying, would I overweight growth companies? Maybe you want to have a market cap weight of growth companies as a starting place, right, Weston? But then, for your individual situation, talk to your advisor. But I would say that looking forward, maybe the opportunity of that technology will be in other parts of the market.
We're so excited about artificial intelligence. And many of you know, in the software that we designed, the retirement budget calculator, we have, I believe, if not the first, one of the very first AI assistants to help people navigate questions. It started out by creating a community portal where we could crowdsource and ask one another questions. Now we have artificial intelligence built into it. It's going to transform the world, absolutely. But one thing that I am certain of is that we're not going to go backwards. We're not going to stop it. We're not going to put the brakes on it. So we embrace it and we navigate as we move forward. I'm very excited about artificial intelligence. I want to talk about fear and greed, because these are, and we're going to take a little bit of a different turn. A lot of times when people become fearful, what I hear them saying is they want to buy gold. And when they start to get greedy, what they want to talk about is Bitcoin. And so I want to change the conversation and talk about these two assets where we see a lot of fear and a lot of greed. And I'd like both of you to go ahead and comment on your thoughts about gold and Bitcoin as an investment. Natalie, you start.
Yeah, it'll be pretty short. I mean, at Vanguard, we're not going to launch a Bitcoin ETF. We don't support it. We don't see a role for it in a portfolio. We see it as speculation, not investing. So, you know, I really don't have too much to say on Bitcoin.
Speak on when you say speculation versus investing, because I think people are confused with that. Can you talk about what you mean?
Yeah. Well, the thing is, Bitcoin has no underlying cash flows, right? There's no store of value. You're not getting coupon payments like you do on a bond. Basically, Bitcoin is only worth what the next person is going to pay for it, right? There's nothing underneath of it. I don't know, does that help?
Gold, I mean, when you think about gold in the same framework as Bitcoin, how do you think about gold as an asset for investing?
I mean, I guess
Is it just speculation?
gold does have some value, right? Different than Bitcoin, but I do think similarly. It's
About getting all gold teeth.
yeah. Maybe going back to the comment when I was talking about commodities and being an inflation hedge, I think gold has some benefits there, but for my money, I want to have a more diversified commodity portfolio, not just relying on gold. You know, having other precious metals and oil.
I am very pleased that Vanguard has the same opinion about Bitcoin as we do. There is no unexpected return there. If you want to speculate in it and have some fun with it, fine. Just don't confuse it with an investment idea. What about gold? Well, my first observation about gold is if you're going to have any sort of substantial allocation to it, I also suggest you get some weapons training. So when someone overhears you at a cocktail party bragging about your gold and comes with a revolver to your door to steal it, you have some way of defending it. All right, now on a slightly more serious note, I'm indebted to Warren Buffett for what I think is the most useful analysis of gold. I'm going to get some of the numbers wrong because I'm doing it from memory. He had never mentioned, I read his annual report letters religiously every year. And he's also always a delight to read. And he never mentioned a word about gold for years and years and years in his annual letters. And finally, 5 or 6 years ago, he had a fairly lengthy discussion about gold. And he said at that time, what if you took all the gold in the entire world, all the gold bars in the vaults at banks, the Federal Reserve, all the gold, everything, and melted it down to one great big block? How big would it be? About 69 feet square, turns out. I forget the exact numbers, but the value of that gold at that time was something like $26 trillion. I mean, a big number. And he said, well, what else could you buy at that time with 26 trillion? He said, well, first of all, you could buy 26 companies the size of ExxonMobil. You could buy all of the cropland in all of America, every soybean field, every cotton field, every cornfield, and get a river of income from all the crops you could sell. And then you'd still have about $1 trillion or so of what he called walking around money. You get that block of gold. Are you going to get another little block of gold in the mail as a dividend ever? No. You hold it for the next 100 years, and you're going to have the same block of gold. So the only way you could make money on that gold is to sell it to someone even more frightened of the future than you are. Conversely, what are you going to get with that portfolio of all those companies and that river of income from every acre of cropland in all of America? You could reinvest that in more securities and more interest-bearing things and more companies if they hatch them. So to my mind, gold is something that you buy and hold as some sort of pacifier when you're terribly worried about the future. And I would always urge you to write down exactly what it is you're worried about. Because I don't think those worries are going to be anything new. And my advice is, I understand that for many, gold is an emotional topic. I'm not trying to argue never to own gold. I am suggesting maybe the most useful solution is to take 2 or 3 or 5% of your portfolio and put it in gold. And if that allows you to sleep at night with the remaining 95% invested in securities with expected returns, either bonds or stocks, maybe that's the best solution for you. For me, I would prefer to restrict my gold holdings to jewelry which my wife can wear and have a consumption dividend of pretty necklaces to wear at the next cocktail party. And as far as Bitcoin goes, it's just it's a speculation, it's a shiny object. It's kind of like art, in my view. Does it have an intrinsic value? No. Do some people get excited about it? Yes. Does it belong in your investment portfolio? I think not. Does it mean you should never ever own it? No, go ahead, have some fun with it. Just don't confuse it with an investment asset.
So let's go ahead and turn this over to you guys now. Let's take some questions from you. And Jim, since you had your hand up, we'll start with you.
Thank you. My main question was answered by Natalie already. It was about how is AI changing the knowledge base and investment strategies, and you answered all that. But since I have the mic, I'll ask one more thing. Did you follow the concierge or the Google, Jason?
Oh, thank you. Well, Jim, which one would you have taken, the concierge or the 3,000 reviews?
Well, I think the concierge probably had a vested interest in the place he was recommending, and he got a kickback, so I'd go with the Google.
I had that same sense of skepticism about the concierge. We went with the Google review because we believe in the wisdom of the crowds, and there's not a conflict there. And that's exactly, as I was thinking about it, I was like, that's exactly what we do with investing. We believe in the wisdom of millions of participants coming together to determine prices and to determine how dollars are allocated across the globe. And yeah, thanks, Jim. Go ahead, Ali, you choose. Oh, this is going to be a good question. Let's hear it. Let's hear it, Dave. Is it a joke or is it a question?
Yeah, two questions actually. My dream stock would be one that's, I guess, attached to AI, and when it's going up, it's long on the market, and when it's going down, it's short on the market, and it changes, you know, a dozen times during the day. Is there any stock like that? The second question is, do you see any value for the government putting all revenue into annuities so that the general populace can gain when the market is going up and not lose anything when it's going down?
I guess the government has taken a pretty big bet on annuities. It's called Social Security. It's the biggest annuity of all. Some people call it a Ponzi scheme. But in terms of speculation, though, you hit on a really important point, and this is something that we hear from people all the time when they come in to meet with us, is they want to take concentrated bets in individual companies. And whether it's gold or Bitcoin or trying to pick the next big AI winner, we just don't invest like that. Again, one of the things that makes us unique is that we focus on people that are just getting ready to retire and people who are already retired. And most people say, Jason, at this point in our life, we're not trying to hit any home runs. What we want to do is earn a fair rate of return on our money, try to earn a couple of points above inflation, keep our money working hard for us, and be able to sleep well at night. And those are the types of strategies that we employ for our clients. We're not the type of investment firm that's going to speculate or gamble with clients' assets. That's just not what we do. And that's why we believe in being long-term investors and being broadly diversified across asset classes, sectors, and across the entire globe. Anything you want to add to that now?
Vanguard would say, own the haystack. Don't try to find the needle. You know, we're long-term investors as well, I would say.
I think humans, or at least some humans, are hardwired to want to speculate. And there may be some sound evolutionary reason why humans are hardwired to want to speculate. But our message, and I'm sure it's the same message Vanguard would say, don't confuse speculation with investment. I am not urging you to never speculate. It can be fun. Go to Las Vegas, have a ball. Just don't confuse that with investing. And if there are some securities you want to dabble with, fine. Set up a separate entertainment account. And make sure it's labeled your entertainment account. And I would always urge you, before you buy or sell something, write down why you think it's such a great idea. Have some fun with it. And we have one advisor client who takes us a little step further. Whenever they have a client that shows up and says, I want to buy this hot stock, it's a great idea. They say, you really shouldn't do it, and we're not going to buy it for your portfolio. But we're going to buy it for our house account. A real account with real money, and every hot idea we hear from a client, we buy it in that portfolio, that account, and we keep track of it that way. You can imagine how well that account has done over the years.
If a person has some real estate, commercial real estate with a pretty fixed income, with hopefully a future to have it increase when they finally sell it, how does that affect how you invest? Really, probably quite a bit bigger portfolio in the stock. Does that make it more conservative or less conservative?
Well, we love real estate as an investment asset class. We've worked with a lot of clients that have done really well in real estate. And one of the reasons we love it is, again, retirement is all about cash flow. It's all about making sure you've got enough income coming in to cover your expenses. And one of the great things about real estate is that it produces cash flow and it's inflation adjusted income. So, and that gives me an opportunity to call out a friend of mine that's here tonight. Brett Warner, sitting back there in the corner, is a good friend of mine that specializes in investing in real estate here locally. And he's just been a great resource for our community. So I had asked him to come out tonight. I just want to let you guys know. Brett, if you want to raise your hand or something. So if you have questions about real estate, I'd say he's a good person to talk to. When we're building retirement plans, we consider the cash flow coming in from the real estate. And we consider it a fairly secure cash flow. I mean, as long as it's something you've held for a long time that's done well for you. And so what that does is it allows us to take smaller portfolio withdrawals, is really the way that we think of it. And of course, there's capital appreciation there as well. So real estate's a great asset class. It's generally better if you bought it earlier in life and now you're holding it later in life and it's producing income for you. It's hard to, at the current valuations, to buy real estate and really make it cash flow for you, at least in this community. And do you guys want to comment on real estate as well as an asset class? No?
Thank you for putting this on tonight. I just want to say I really appreciate the thoughts, especially talking about things like AI and whatnot, because that's where I've been focused for the last 5 years. Internet started with Internet of Things and then went on to robotics. And in the roaring 90s, the roaring 90s of the 1990s, I was highly invested in what they called the 4 horsemen of the apocalypse or whatever. And then making a lot of money and losing a lot of money. So it was a very volatile market back then, but overall I made money. But my question is, one of the things we have not talked about tonight is trends. I like to look at trends. I read about trends. I read about things like robotics, AI, and the power, the infrastructure necessary. We didn't talk about that when you talked about AI. The fact that you have to build out infrastructure and you have to make You did mention power centers, but that's going to take a lot of silver, a lot of materials, raw materials. So you can invest in AI without necessarily investing in the software or the component gadgets that are built into it, like companies like that you talked about. So my thing is, I think that is there any value in creating a portfolio, or at least a portion of a portfolio, based on what you see as future trends? I read a book called Megatrends 2000 back in the 1990s by a famous author who is in the Bay Area. I think the author lives in the Bay Area, but he was talking about all these trends. And I've gone back and looked at that book periodically since I read it in the 1990s, and virtually everything he has said has come true. So I think that there's value. You can forecast the future if you don't look at a particular company, but you look at a trend and whatever is needed to support that trend. Thank you.
Trends. Are you the only person in the United States who is actively trying to figure out these trends? No. Are there thousands upon thousands and thousands of researchers and Wall Street analysts and corporate executives and technology entrepreneurs also trying to figure out these trends? My best guess is yes, a lot of them. Are the payoffs from these potential trends, whatever they might be, in robotics or AI or drug discovery or anything you can think of, are those already reflected in today's security prices? Maybe they are, maybe they aren't. My best guess is you believe they are not reflected in today's prices.
Not fully.
I would argue that I think they are reflected in today's prices, because there are so many market participants, just like you, who are spending a great deal of time and effort trying to figure out not just what the next 6 months will bring, but what the next year, 5 years, 10 years will bring. They're constantly chattering every day with top software engineers and technologists about late-breaking technology. Maybe technologies none of us in this room are even aware of. I think it's a very extreme position to take, that any of us know more about the future of any particular technology than the collective wisdom that's already being expressed in today's security prices. It doesn't mean you won't find a super stock now and again that does better than most people expect, but chances are security prices for all of these mega trends are already doing a good job trying to put a proper price tag on an extremely uncertain future. You may be entirely right about predicting which technology will emerge as the winner, and still get it wrong in which particular companies are going to profit the most when that innovation surfaces. That's the challenge of trying to outfox the collective wisdom of all other market participants. You may be the individual who does it. Chances are you won't.
I was actually thinking as Weston was talking too, that maybe where it might not be in prices would be in the undervalued parts of the market or the lower valued parts of the market, like international value stocks, small cap, right? They probably don't have a lot of AI potential baked into them. And I'm not saying it's a reason to allocate to them the reason, but it might be a reason if you are already thinking about, oh, I want to put a little more value in the portfolio to counterbalance the growth that's priced to perfection, or to be an international or small caps. Pretty undervalued parts of the market vis-a-vis history. So maybe that's an opportunity.
BlackBerry. We called it Crackberry. How can you go wrong? Look at the cell phone thing is exploding. If you look back at the top 10 companies by market capitalization 20 years ago, only one of those companies still exists. 20 years ago, BlackBerry was one of them. Yeah, Palm Pilot was another one. So rather than trying to pick the specific company or to spot the trend, what we want to do is be broadly diversified across asset classes, sectors across the entire globe, and capture the returns wherever they occur. Not trying to hit a home run, Steve. We're just trying to earn a few points above inflation so that your money continues to work for you in the good times, and in the bad times you don't get wiped out. Because there are companies that go to zero, and that hurts. And we don't want to be in a position where you go to zero on a position because of a bet or gambling or speculation. We don't gamble. We don't bet with clients' investments.
I have a question from our YouTube now. Do you see the government revaluing gold?
Revaluing gold. Do you guys have any comments on gold as an investment or revaluing? An interesting thing that I've been thinking about lately is the fact that Russia and China have been buying massive amounts of gold. And I wonder what their purpose is for that. Now, you can look at what's been happening with the devaluation of the dollar and all of the printing of money that we've been doing. And this is all, just Jason laying in bed late at night wondering about the reason for owning large amounts of gold. Could it be that China and Russia want to create some kind of new world reserve cryptocurrency that's backed by gold and do something to replace the dollar? Is there something possible like that? I would say there's always risks for something like that happening. But do you guys have any comments about gold?
I would just take issue with the notion that the U.S. government somehow controls the price of gold. Investors control the price of gold. It's a free market for gold. So it may go up, it may go down, but it's just going to be a result of not government action, but opinions of potential sellers and buyers of gold all over the world. It doesn't change any of my opinions about gold, whether it makes sense as an investment or not. I think I've tried to be clear on that. I think it's maybe a useful emotional crutch for many of us, but gold is so volatile, it's not much of a hedge against anything.
The next one I have is, how do you overcome fears of spending when first retiring?
Wow, that comes back to the core of everything that we teach all the time, is that you've got to have a good plan. It's your plan that's going to give you the confidence. The implementation of the investment strategy is just there to complement the plan. The tax planning that we do is there just to complement the plan. But the plan is the most important part. And I should say it's not a plan, but it's the planning that's going to give you the confidence. It's the ongoing process of revisiting the work that we're doing to make sure that you're going to stay on track. Now, there have been times when we've met with people and we've said, hey, you need to reverse course here. You need to scale the spending back. This isn't working. You're going to blow up your plan. Just like there's a sequence of return risk, there's a sequence of spending risk. If you spend too much in the early years, you can blow up your financial life. And so you do need to think deeply about cash flow. But the one thing I really work hard to do is help people not make decisions based on fear. In Matthew chapter 25, the parable of the talents, the one that was given the least buried it because he said, I was afraid that the master would return. And when the master did return, he was cast into darkness, and there was gnashing of teeth, and it was really, really ugly when you make decisions based on fear. So we use the plan to make decisions, not fear.
And then the last one that we have so far right now is thoughts on how much money to keep in an IRA versus converting to Roth to take advantage of the standard deduction.
Yeah, so, the One Big Beautiful Bill Act just passed. I just did a podcast on this, and I do believe, especially for those of you who are over age 65, for the next couple of years, you're going to get an additional, if you're a married couple, an additional $12,000 added to your standard deduction. So if you haven't started Social Security yet, and you're in that range from 65 to 70, this could be a really great opportunity for the next couple of years to do some strategic Roth conversions. The hard part about taxes is you can't listen to a YouTube or a podcast and make decisions and only look at the 1 year and say, how is this going to impact me over 1 year? You want to really be thinking about how are these decisions going to impact you over the course of your lifetime. And that's the work that we do. And that's the work that we built into the retirement budget calculator. Many people that are tuning in today, they're not necessarily clients of Parker Financial. We're not walking life with them from an investment standpoint or financial planning standpoint, but they're using the software that we built. And in that software, you can start to model out how much money you'll pay in lifetime taxes and make more informed decisions about future tax implications. But there are some really amazing opportunities, and if you want a deeper dive on this new bill that was passed, I would encourage you to go listen to the latest episode of Sound Retirement Radio. Do you guys have any comments there on Roth conversions? These guys are more investment folks than financial planning.
Thanks for the opportunity to ask this question. My name is Randy and I'm a guest of Ora's. I'm currently 66 years old, and in October I'm going to be doubling my income as I augment my my retirement payment from a government career of 40 years with good old-fashioned Social Security. I also worked in private sector for 6 years, and I'm currently part owner of the consulting firm that I was employed by. I heard you say that there's some opportunity for Roth, which is something I've not been involved in, but I also have an opportunity for my employee ownership for sell-off at 100%, which has never been offered before. We also recently had a rather large gain in the market value of the company. So I've got a big decision to make. I've got till October 5th. Any thoughts?
Randy's got a question that's sounds probably very personal to you, Randy, but I have to tell you, it's the type of question I think most people in this room and most people tuning in today have. They're trying to make complicated decisions, and there's a lot of moving parts, and you can't do this on the back of a napkin. You can't give good advice by saying, well, the general rule of thumb is go do this. You really have to model it out. And if there's one thing that I'm guilty of is being too technical. If there's one thing that, one complaint that we hear from people that use the software that we built, the retirement planning software that we built, the retirement budget calculator, is they say it's too complicated. There's a lot of moving parts. But if you really want to try to model the future the best you can, you need as many inputs as you can to try to understand the outputs. And so without really sitting down and looking at your specific situation and understanding all of the moving parts about starting, because you don't have to start Social Security at 67. Maybe we choose to postpone that for a couple of years and continue to earn those 8% delayed retirement credits. And right now there's an opportunity for long-term capital gains to pay lower taxes on some long-term capital gains. So maybe we consider that, and we try not to get your income too high so that we can do some of those Roth conversions and still take advantage of this new senior deduction that you're going to have available to you. A lot of this stuff phases out. Like I say, it's too complicated to do it without software, is the way that I would say. You need software to make these decisions, or help make these decisions and think through all the what ifs.
Thank you.
Thanks, Randy. Appreciate you being here.
Hello, my name is Kip, and thanks for having us out here. And I was an engineer, so I love the retirement budget calculator and how technical it is. I enjoy it. My question has to do with tariffs, and I just wanted to get your guys' thoughts, because I hear everything from gloom and doom, and we're all going to die, to it's going to be the greatest thing ever. So is there that much uncertainty associated with it, or is somebody not telling the truth?
Good question.
Yeah, I think as I said earlier, I don't like this part of the alphabet, TUV, tariffs, uncertainty, and volatility, and we don't know what the end game is yet. I mean, based on the agreements, and I use that word loosely because I don't think even with the countries or areas like the EU that we have agreements with, that it's all been hammered out. And right now I think the effective tariff rate is getting close to 20% with some of the things we've heard over the last couple weeks. And what we have not seen yet either is what's the impact going to be on you and me. Because if you think about it, if you saw GM said in their latest earnings release that they took $1 billion hit from tariffs. What does that mean? That means they didn't pass it on to consumers, right? That hit their bottom line. But eventually, companies are going to have to pass those on to consumers, at least part of it. So I think, you know, the story hasn't been written. And the other part is too, is how long do they last? Maybe this is a negotiating tactic and it lasts, you know, we have pain for a few months, but then they go away. Really just don't know at this point in time. It's hard to say.
I would just echo those comments and say, keep in mind that when you're investing in stocks today, the prices are being set for expectations over a very long future. And if, to the extent tariffs may be a negative for companies or the economy at large, which seems to be the opinion of most professional economists, they're certainly self-inflicted wounds. So, as you suggest, we don't know what the tariffs will look like a month from now, 6 months from now, or especially a year or two from now. And yet when you're buying stocks today, you're buying a discounted stream of profits off into perpetuity, which is a rather long time. So I can expect to see ups and downs associated with either positive or negative news on tariffs. But do I have an ability to outguess all the other market participants and somehow arrive at a better conclusion about what I should do with my portfolio based on my assessment of what tariff policy might be? No. So I think we're better off just holding on, maybe voting for the candidate of your choice who thinks reflects your views of what tariffs should be, and play more golf.
I'll play pickleball, thanks. You know, the one thing I'll say about tariffs is we've had tariffs now since Donald Trump's first presidency. We had tariffs during President Biden's presidency. Other countries were charging us tariffs before we said, hey, this isn't fair, this isn't right. Why are you guys charging us tariffs? We're gonna charge it back equally, at least be equal with what you're charging us. So tariffs are a negotiating tool. And if you look historically, now again, we can't make predictions about what the future is gonna hold, but we can say that whether or not we've had Republicans or Democrats in office, the market has performed really well. And it's not because of Republicans or Democrats, it's because the American people are incredibly resilient and incredibly innovative and incredibly generous. And we build amazing things. I mean, ChatGPT 5 was just released today. Everybody's got a PhD expert on every topic in their pocket right now. And that's exciting. So tariffs are part of global trade, and I'm not going to worry about it. Like Weston said, I'm a believer. See, what the market is a collection of businesses that produce goods and services that make our lives better. And companies aren't going to stop producing those goods and services because we need them, we consume them, we want them. And as long as businesses continue to produce goods and services, and you and I buy those goods and services, well, that's a good thing. And will tariffs increase the cost of goods, like Natalie says? Well, probably. Will increase revenue to the United States. Looks like that's happening so far. If prices of goods go up, will we pay more money in taxes when we buy those things? Probably. Is it a way to generate more revenue and deal with $37 trillion of debt? Probably. You know, we've got all kinds of things we could be thinking about. But again, I'm optimistic. I'm optimistic because I believe in human ingenuity. And that's the piece that I want you to take away tonight, is that businesses produce goods and services that make our lives better. They create jobs and profit and revenue, and all that's going to continue. It's not going to stop. We're not going back to a bartering system. If you ask me if you wanted to buy the carrots in my garden and chip off little pieces of gold, and you think that's the way that's just not going to work. We're not going back there. It can't happen. My carrots are horrible.
What about REITs as a real estate investment rather than investing in individual properties? Should this be considered an equity investment?
Publicly traded REITs can be a portion of a portfolio to give you some exposure to real estate. One asset class that I've seen people hurt, probably one of the asset classes, master limited partnerships and non-traded REITs are two areas that I've seen people hurt the most when I've met with them. They come in to meet with us and they tell me stories about what they purchased. So, one of the things I think as advisors that we do is we just keep people that are in retirement out of stuff that they don't need to be getting involved with. So I think a lot of you already have a lot of exposure to real estate just through your primary residence. It can be a diversifier to enhance returns, sure. Just make sure it's the right type of tool. And if you're not sure, a quick question to ask somebody if they're trying to sell you one of these things is ask them if they're getting paid a commission to make the recommendation for you to buy one of these REITs. And if they are, then you really have to question whose interest they're looking out for. Are they trying to do what's right for you, or are they trying to sell you a product that's going to make them a lot of money? That's why I think it's important to work with a fiduciary, somebody that has a legal obligation to act in your best interest. But you guys, what do you think?
Just speaking from dimensional standpoint, we have a large number of institutional clients, and many pension funds among institutions own real estate directly. And when we were a number of years ago asking these investors, do you invest in real estate? Many of them said yes. And then we asked, well, how do you feel about investing in the real estate properties you've been using so far? And many of them said, well, it's about 5% of our portfolio, and it's 95% of our problems. They've got leases coming due, tenant squabbles and so forth. Managing it was a hard work. I said, well, we're thinking about launching a real estate investment trust that would give you exposure to a broad swath of income-producing commercial properties across the U.S. Would that interest you? And enough institutions said, oh, yes. That we launched one. Now we're certainly not the only one who has a publicly traded REIT. I'm sure Vanguard has one. Yeah, and both. It's a very good way to get exposure to real estate, professionally managed and very low cost. And to the extent you may be interested in having property holdings as part of your portfolio, it's a good way to diversify and add property exposure without the headaches of actually owning property. You do want to be careful about having a low-cost structure and a clear understanding of what management fees you will be paying. And I'm pretty confident that between Dimensional and Vanguard, we have about the least expensive exposure to real estate that you could find anywhere.
Thanks for making the low-cost statement, Weston. I appreciate it, and I would echo your thoughts. Diversification. It's a way to get a diversified exposure to real estate.
All right, well, that's great. I think we got through all the questions and we did it in time. I just wanted to wrap things up by, once again, thanking our guests. You guys traveled from all around the country to be here tonight, and so I really value the relationship that we have with Vanguard and Dimensional Funds. Thank you both for being here. Will you guys put your hands together? And just again, it's been such an incredible opportunity for us to get to walk life with each of you, and to be on this journey with you, and to get to celebrate the wins, and to plan and to dream. I was telling a friend of mine, it's like some people go into counseling and they help people through the hardest parts of their life. We get to help people dream and give and live rich, full lives. It's just wonderful, wonderful work, and I'm so grateful for the opportunity to do this with you. I'm grateful for the opportunity of the people tuning into YouTube and the podcast, and the people using our calculator from around the country. I just feel this sense of gratefulness and gratitude for the opportunity to do this. So thank you all for being here.
Really quick, if you do want an email with Jason's ebook on the investment philosophy, please give it to one of us three. Thank you.